Hey, it's your girl, KV.
And Celine.
And we're back with another episode of the Hood Health Report. Today we have a very important topic, something that is pertinent to everybody living in today's time, and that is credit scores, the credit score system. So, doing this research, I was kind of surprised that the credit score system is as new as it is. I'm like, this was born when I was born, basically. So even though they've had credit reporting around since the 1800s, the actual credit score system that we know of now is a new concept. So,
Who said that?
The Fair Isaac Corporation introduced their FICO score, the first consumer credit score, in 1989. The only other popular credit scoring model that we currently use are the Vantage scores. These were created by the three major credit bureaus, Equifax, Experian, and TransUnion in 2006. And that was crazy to me that one was so new as well, because that was the only one I really knew about for a while. It wasn't until maybe 2 years of me really tracking my credit report and my credit score that I found out about the FICO. And I'm like, oh, this is the one that we're really, really supposed to be looking at. I just would do the Vantage scores because that's what they would publicize the most. But I guess because it was the newest one, so they were trying to make sure everybody knew about it. So Vantage scores use a slightly different method to generate scores. Your credit score is based off your credit report, which includes your history of credit card usage, loans and repayment status, hard inquiries, which is how often you apply for new lines of credit, and public records such as liens and bankruptcies.
So I'm going to go over some of the differences between the credit report and a credit score. A credit report and credit scores both give an idea of a borrower's credit risk. They're not the same. A credit report can list the person's personal information, credit account information, hard inquiries, and public records like bankruptcies. Credit bureaus compile these into a credit report. Credit scoring companies use information from a credit report to calculate your credit scores. Since there are multiple credit scoring models, you probably have more than one credit score, and these scores can be used for lenders to make their lending decisions. Another takeaway is that the modern credit score models give lenders an easy and fast way to determine an applicant's risk for a loan. They also help keep lending practices fair by ensuring these decisions are based on factors like payment history and the length of a credit history, and not personal factors like age and your marital status.
So that is very important to mention, because the next article, When Did Credit Scores Start? A brief look at the long history behind credit reporting, actually mentions that the first kind of system that they had was based purely off word of mouth. So credit scores were created to evaluate whether a potential borrower would be able to pay back their loans in full and on time. A credit report and a 3-digit credit score also determine how much interest you will have to pay on a loan, as well as the types of loans or credit cards you can qualify for. In 1841, the Mercantile Agency was funded as one of the first commercial credit reporting agencies, using people known as correspondents to collect information about lenders and borrowers across the country. These correspondents would collect info about a business person's marital status, ethnic background, and credit history and age. So they would literally just go around your neighborhood and ask who they thought was, prominent business persons. Well, what do you think about Celine? Do you think that she'll be able to pay off this mortgage loan that she's applying for? And they might be like, well, she is kind of young, so maybe not. And she's unmarried, so we don't know what type of income she's making on. And she's black, so, you never know with those people. Like, that's literally how it went. Which was crazy to me, because I'm like, dang, that probably kept a lot of black people, of course, or women in general. From getting loans or getting businesses started. And, I'm glad that they moved away from that system.
In a sense.
Air quotes. So This method relied on the subjective methods of evaluation because what exactly could race and marital status indicate about mortgages and car loans? It wasn't until the late 19th century when department stores and retailers gained popularity, and with that, credit reporting took off. That was funny to me as well, that, okay, we want to sell people these jewelry and these, sofa sets, so we know they're not going to be able to buy it in full because these are expensive items, so we have to get some type of credit score or credit reporting system together to be able to, give them loans and make sure that they can pay back this stuff for some jewelry and some furniture. But I guess those were like the big ticket items back then, because it wasn't like, iPhones and laptops and things like that. Where
TVs, like flat screens, smart TVs.
Right, they had the big bags, the big TVs back then. So this made it easier for people to pay over time for expensive items. Nowadays, we can't walk in a retail store without them trying to sign us up for a credit card, and it's just very predatory. Like, that's another reason why I don't even like going into stores sometimes, because they are so like, oh, would you like to sign up for our card? Oh,
they did that to me yesterday.
If you get approved, you'll get 15% off of your purchase today, and da-da-da. And it's just so ridiculous. And of course, when I was younger, I fell for the scam.
They got you.
They got me. I had the most unnecessary credit card ever. I had a Victoria's Secrets card.
I love them too. I didn't get a card, but I could see myself wanting one of those.
I had a Victoria's Secrets card as if I needed that many panties and body sprays and things, but it was predatory, and it was just like, okay, well, they're telling me I can get it, so why not? Like, worst credit card to have, because you just really don't need. Who needs that many bras?
Yeah.
Who needs to get a credit card for bras? It was crazy. It wasn't until credit reporting became computerized in the 1960s that the industry would become consolidated. Today, FICO scores are considered to be the most widely used. This was cemented when Fannie Mae and Freddie Mac started requiring mortgage applications to submit FICO scores in the mid-1990s. Nowadays, the subjective factors such as race, age, gender, and marital status are no longer used to determine credit worthiness. Instead, the following 5 factors are used to calculate FICO credit score. Number 1 is payment history. This is worth 35%, and this is just basically whether or not you pay your credit cards or any other loans on time. Number 2 is the amounts owed, which is 30% of your credit score. This is the total amount of credit and loans you currently have, and is compared to your total credit limit, also known as utilization. So for instance, if you have 3 credit cards and your credit line equals out to $20,000 for all of them, if you owe $19,000 on that $20,000 worth of credit line, that percentage goes way down for that amounts owed. So length of credit history is worth 15%, and this is just the length of time that you've had credit. And this one is the one that annoys me the most because it can affect your credit score just because you pay off a credit card or something like that. If that was your longest piece of credit history and you pay it off, and now your score drops because you don't have credit for the same length of time as you did before you paid that off.
And then also, if you get another credit card, it affects the length of time too. So they cut it in half. So it's like, okay, well, dang.
That's number 4. New credit, which is 10%. How often you apply for and open new accounts. So if you're one of those people that every time you walk into the store, you're like, oh, sure, run my credit to see if I'm eligible for this credit card, then it's going to affect your credit score because you're constantly opening up new lines of credit. And number 5 is the credit mix, which is 10% of the score. And this is the variety of credit products that you have, such as credit cards versus installment loans, etc. So now some people still feel that this can be biased in favor of homeowners because rent and other bills are not reported. They're not taken into account when you think about your credit score. So recently, to combat this, Experian created this program called Experian Boost, and this was launched where people could include recurring payments such as rent and utility and other different bills that they can report to it to show that they have paid their bills on time. And this can help boost their credit score. So in the U.S., about 26 million people are considered to be credit invisible because of the lack of credit cards and mortgages. And of course, this disproportionately affects minorities and low-income individuals. Experian Boost could be a major factor in proving these people's creditworthiness. So even though credit reporting isn't as racist or subjective as it once was, it can still affect us in the same ways. Because if we aren't able to buy a home and we haven't got a credit card because we grew up thinking credit cards were bad, you know, we still are starting at ground zero with no credit, so that might as well be bad.
I'm going to just continue on with a little bit more of history. So this next article, The Long Twisted History of Your Credit Score, it just goes more into that. As you mentioned earlier, the Merchant Agency, founded in 1841 by Merchant Louis Tappan, in the panic of the 1837 Depression, caused merchants to overextend their credit. Tappan set out to systemize the rumors regarding these debtors and characters and their assets. There were two important consequences from this. The first is that it reinforced the social hierarchies, serving as early as the early form of redlining, which we were just talking about. People who didn't have a place or they were in certain areas were subjected to not having good credit scores because of where they lived. And then also, by the end of the Civil War, there were three pillars of modern credit reporting where they were placed, which were the private sector, which had mass surveillance that made the credit reports possible. And they also gave information as far as sharing through their systems. It would take nearly another half century, however, before all three of these pillars would be transformed from commercial to consumer credit evaluations. This is when the computerization of credit reporting data resulted not only in congressional investigations, but also in the passage of the Fair Credit Reporting Act in 1970, a landmark piece of legislation that required bureaus to open up their files to public and expunge data such as race, sexuality, disability, and delete negative information after a specific period of time. This was really important because a lot of people weren't able to receive credit because if you're, black, or if you're a woman or something like that, then you were looked at as someone who wouldn't be qualified to have, good credit. It was difficult interpreting and comparing the reports. To resolve this, they began working with tech companies to develop a credit scoring algorithm. The companies was the Fair Isaac and Company, though it's now known as FICO. The Fair Isaac and Company were well positioned to take on the task. Founded in 1956, the firm had already been selling credit score algorithms for decades when the Big Three began their quest for an industry standard credit score. The result, which hit the market in 1989, was remarkably similar to the algorithms still used today. The credit scoring is anything but universal. Credit reporting can function as a way of maintaining social hierarchies, which we kind of already spoke about, especially among poor Americans. Low credit payments and higher interest rates on purchases can put a strain on those household budgets that often result in higher rates of bankruptcy and default payments, which can, in return make your credit score lower and put you at even more of a risk of having a low credit score. Credit reporting was essentially to open the financial opportunities to...
Start that over. Essential.
Credit reporting was essential to opening financial opportunities to a broader cross-section of Americans. FICO scores do allow individuals to move more easily between lenders. Credit reports are used to inform decisions about housing, employment, insurance, and the cost of utilities.
And that part is also very problematic as well, that some jobs will actually use your credit score as a way to determine if you would be good at this job? Because I'm like, what does my credit say about what type of job I'm gonna do?
Or like, yeah, what does that have to do with me completing a job?
We got a production comment back behind the cameras.
Yeah, most businesses, when they look at people's credit, they look to see if they're going to waste their check away, or they might have some type of, it's more so for like the higher ups. So if I know you got a bad credit score, I'm less likely to hire you because you might be a liability to the company, because if I give you this debit or credit card, I'm not too sure if you'll misuse it or not. So sometimes that's what they kind of look at for those persons.
Definitely in my company, that's why we look at credit scores.
Yeah.
Because we hand out corporate cards, we hand out bonuses and stuff like that.
So with that, do you completely deny somebody if their credit is bad, or you just know that this person would not get a company card?
We deny them in some positions, certain positions, especially if it's dealing with money, if it's dealing with anything like that. If you got bad credit, you're a higher risk to steal, embezzle, stuff like that. So we gotta say no.
I feel like if you're gonna embezzle, you're gonna embezzle, whether you got bad credit or not. I understand it as far as the holding a credit card part goes, but I still feel like
It's more of a risk factor. What do they call those people that come in and do that risk
Audits. They do audits. That's not the technical term of it, but they pretty much do the audit. They do the audit for companies. It's called assertion work from a financial stance, but they pretty much come in and they go through the company's financials with a fine-tooth comb, and a lot of times they do find, well, it's gotten better, but a lot of times, especially with hedge funds, hedge funds, venture capitalists, private equity firms, when you're dealing with mergers and acquisition firms, law firms have gotten hit. A lot of CPA firms has gotten hit. Title companies recently has gotten hit because in Memphis there was a title company who literally stole the like $500,000+ of their own clients' money. And the title company is meant to hold money. Like that's the sole purpose of a title company, is for you to hold the money until we close. And somebody in Memphis literally stole their money. So
I wonder the statistics on that, as far as I hear what y'all saying, but like as far as like, okay, looking at the people who've got in trouble for embezzling or stealing the funds and everything, what percentage of them really had poor credit and what percentage of them just wanted to keep up with the Joneses in general? You know what I mean? They might have had decent credit, they just didn't have the means to get the fancy things versus, okay, well now if I got access to this and I got decent credit, you know.
You have a good point, because you have a lot of people with great credit, but they live in, under a rock. They got the biggest house, they got the biggest.
That's what I was about to say too.
So,
they living beyond their means. Sure.
That's it.
They definitely living beyond their means.
Or vice versa. What if you just have bad credit because you never owned anything or something like that, so now you're being denied a job, but it's not because you don't have trustworthiness, it's just more so you just didn't have that line of credit built before you apply for a position.
And also a lot of what tends to happen a lot of times is people aren't given access to these tools like credit until 18 years old.
Exactly.
Right? Especially for Black Americans, Latino Americans, we don't know the credit game.
No.
We don't.
Because I'm not gonna lie, in my household, mom was like, nobody get a credit card.
Same.
I didn't get a credit card till I was like 21, 22.
I think I got my first one just through our bank because I needed to pay for books for school. But like outside of that, no.
That's actually the worst time to
Right.
Where vice versa, you do have, I'm not just gonna say, others, non-Black and non-Spanish people, but you do have others who literally open, once their child is born, they open a credit credit card.
Or they put them on as like a person that they can use.
Authorized user.
And I didn't even know about that until
I didn't know about that until a few years ago, and so I was like, what age do we do that for our child? So, so that when she gets to the point of applying for things or needing credit, that she's got it, because I've been an authorized user on my mom's credit card since I was 12, and she kept up with the payments and never went utilization over 30%. So she's got great credit by the time she's 18, 19, 20. So it's definitely ways that certain communities are still disadvantaged through the credit system, even though the credit reporting and the credit scoring isn't overtly subjective. Yeah. And I use that word overtly very strongly.
Yeah, because I think about also people who parents might have put them on something and they didn't know nothing about it, and then their credit's ruined before they even get a chance. So it's so many different ways that could play out as far as saying somebody's trustworthiness because they have a high credit score versus a low credit score.
Yeah, it'd be funny. It's like a 7-year-old with a light bill. Like, why do you do that to that baby? That baby ain't have a chance.
No chance at all. And then they grow up and they're like, oh, well, dang.
I ain't never had no light bill. I was 10 years old when this light bill got put in my name. And they like, well, baby.
That's what it says.
You can't do nothing about that. Yeah.
So continuing on, this next article, How Race Impacts Credit, the History and Effect on Lending Practices. Credit scores help lenders assess someone's risk for defaulting or borrowing money. But as we just discussed, that's not necessarily always the case. The higher the credit score, the less risk you pose, apparently. Or high credit scores make accessing credit lines with better interest rates much easier as well for those people. The Federal Reserve Board did a research study that shows Black, Hispanic, Native American borrowers generally have lower credit scores today, even when researchers control other factors like education and income. In the past, gender and race were both factors that lenders used to discriminate against people seeking financial services. For example, practices like redlining, which is when an institution refuses to or withheld financial products like mortgages from people in financial high-risk areas, made it almost impossible for people of color to get home loans. Lending practices started to change in around the 1960s, 1970s due to diligent work of activists, some of which were part of the civil rights movement and the women's rights movement. They helped create anti-bias legislation such as the Equal Credit Opportunity Act, which Congress passed in 1974 to protect against discriminatory lending practices by prohibiting creditors from using race or gender to make lending decisions. Instead, lenders use factors like income, debt, recurring expenses, and credit history to determine whether or not somebody could receive credit or receive a loan. Now lenders use credit scores to determine the approval for things like credit cards, mortgages, and auto loans. So I'm going to kind of explain what a credit score is for people who might not know. It's that 3-digit number that represents your credit worthiness. It can be anywhere from 300 to 850. 300 is very poor. 850 is excellent. If you're trying to determine where you are on that scale.
That made me think of those daggone internet questions where they like, would you rather have $1 million or a 750 credit score?
What would you rather have?
Give me the money.
I'm saying
money will get me to pay off everything to where my credit score can easily be at 800. I can pay off everything I owe with $1 million. So the people that be like, well, if you get the 750, you can take out a loan to get whatever. Just give me the bill. I don't have that much debt to where taxes and debt gonna eat up all the money.
I'm the same way. I'm like, I think I am very,
Does production have a
I'm definitely giving the 750 because if you take the money, you have to pay taxes on that. But if you take the 750, you can get a loan on it. that could be up to $1 million or even up to $500,000. If you know how to flip that, you know how to flip that. And the whole thing is, you're not taxed on debt. That's the real reason why a lot of wealthy people say build, borrow, die. Because they don't want to pay taxes. And that's how a lot of, big corporations get around from paying taxes, because they got a lot of debt on their books.
So you said you're not taxed on debt, but what about interest rates, though?
You're not taxed on that. They can't tax you on that.
But I feel like interest rates,
they be crazy sometimes.
Interest rates be in.
But I mean, I guess if you got a 750, your interest rate not gonna be. But if you got like $1 million,
I would still want the $1 million.
I
ain't got that much.
Okay, so here's
Me, I'm taking $1 million.
If I'm able to have a 750, and like I said, if you know how to flip that, you know how to flip that. So if I know of an asset that I can buy, that's why people always talk about real estate, because real estate is a very, I don't want to say simple, but for the sake of the conversation, real estate is a very simple asset concept for people to understand or for people to grasp. So if I buy an apartment complex, it's bringing in 1.5 million.
Hopefully.
No, they show you the sheet. So
I'm saying that's if you got all the tenants filled, all the things filled, and they actually paying on time.
Right.
There's a lot of factors that go into that.
Well, that's a part of due diligence, right? So when you go through your due diligence phase, and you see that they're bringing in, just for the sake of conversation, let's just say $800,000. But the seller is only wanting $500,000 for the actual property. You just got $300,000 in equity, and guess what? You ain't, unless you pull the money down and you're not reinvesting, you're not paying taxes on that. And you can borrow back on that asset to get more money out. That's the reason why a lot of people are driven towards real estate, because it's something that they can, if you know how to work the asset, you can pull money down and it's not taxable. So that's why certain people will say, give me that 750 credit score, let me go ahead and get this loan. I ain't gonna pay taxes, and then I'll be having an asset that's cash flowing me, and then I can hand it down to my family.
My answer is still the same. Show me the money. No shade to,
I think it depends on how much debt you have.
I was gonna say how much debt you have, where your current score is, because I ain't all that far from a 750 now. So I'm like, give me the money.
Right.
I had that 750 by the end of the year. If you get me that money, I ain't got too much to pay off of. Just give me the money. But no, I do understand for people that, what's the word? Not necessarily. I know it's good to have things to hand down, of course, have that generational wealth, but I don't want to be nobody's landlord. So that example don't touch me. It don't move me, because I don't want to be nobody's landlord. Don't call me when nothing is.
While race cannot legally affect credit scores, credit score disparities still exist among various racial groups. VantageScore and FICO both state on their websites that they do not include race as a factor when calculating credit scores. However, lenders can access personal information on loan, mortgages, and applications, which may lead to discriminatory practices. So even if you don't necessarily disclose that you're a black person, if they want to know if you're black or if you're a woman or anything like that, they can look on the application, so it kind of still doesn't give you that fair. VantageScore and FICO both state on their websites that they do not include race as a factor when calculating credit scores. However, lenders can access personal information on loan and mortgage applications, which may lead to discriminatory practices. A lender may not directly look at the race to decide whether someone can receive financial services. However, lenders reject minority applicants more often than white applicants, which was reported by the University of California, Berkeley in a 2019 study. The study also found that lenders tend to charge Latino and Black owners 6 to 9 basis points more on interest, leading to $750 million in extra mortgage interest in a year. I also wanted to mention predatory lending It's the practice of lending money with terms and conditions that may be unfair to borrowers and built to benefit lenders as much as possible. The most common include payday loans and some debt settlement services. And I kind of didn't really know much about this, but then I started thinking about it. I'm like, oh, that's when they do like those little commercials where
checking the cash.
Yeah, and it's like they're always in those more black or like places where you're gonna find more minority groups. So I was like, oh, that's what that means. And then it's like basically checking to cash services often replace traditional banks in minority or low income communities where banks are scarce or majority of them don't have banks. These services may offer alternatives for people who don't have checkings or savings accounts, but ultimately is another factor that prevents people from credit building.
This makes me think of the whole rush card scandal that happened a few years ago too. Just, all types of ways that minority people are preyed upon and disadvantaged when it comes to credit.
And then there's a couple of ways that you can try to build your credit score. A lot of these are things that I'm actually working on because like I said, I just started not too long ago. I didn't really have much knowledge, but you can apply for a credit card or a personal loan. Just make sure you do a lot of research and decide what works best for you. If you have poor or no credit, lenders may be willing to offer you a credit builder loan, and then you can become an authorized user, which we also spoke about earlier on someone else's card. But if you are going to be an authorized user, make sure that you're doing it with somebody that has either good credit or they are trustworthy in the fact that they are paying their bill on time so that it doesn't really affect you too much. Create accounts with Experian Boost or Ultra FICO, which are two of the programs we talked about earlier. These reporting agencies will add your bill payments to your credit report to help you increase your score as well. So from the previous articles we've talked about today, the common theme has been race in a lot of these articles. This next article, How Structural Racism Plays a Role on Lowering Credit Scores, speaks more on how racism can or has affected many Americans' credit scores. Credit scoring was first developed as an advancement. A survey showed that 5,000 U.S. adults found that more than half of Black Americans reported having low or no credit, which, it makes sense because we don't necessarily have all the information behind getting credit or like what it looks like, or you have your parents who say you don't need a credit card or they're going to charge you high interest rates or something like that. But having a low or no credit score can often bring severe financial consequences. 42% of Americans said that their credit scores prevented them from accessing financial products like credit cards or even loans. It's important to note that credit scores did create some of these social economic disparities, which a lot of people are they go backwards. They think, okay, well, it's kind of like a loop if you think about it. Not having a credit card, you don't have a credit score. So then when you get a credit score, it's low. So it just kind of makes a credit score loop of you being at that low rate. This simply reflect the social economic disparities that they are already out there. And the conversation should focus on addressing the root of these differences, not necessarily the fact that people don't have credit.
So, from inherent racial bias to incorrect data, the problem with our current credit scoring model. So a good credit score is a gatekeeper to wealth, career opportunities, and housing in the U.S. But some say current scoring models aren't always fair. The purpose of today's credit score system is to eliminate bias. Today, FICO considers payment history, amounts owed, length of credit, new credit, and credit mix in its model. But that data may be influenced by generational wealth that many Black and Hispanic borrowers do not have equal access to, as we previously mentioned. Many Americans have inherited wealth through home ownership, one of the prevailing ways people accumulate wealth. However, for Black Americans, a history of redlining, a discriminatory practice that makes financial services like mortgages unattainable for people of a certain race or geographic location, and outright discrimination has precluded them from buying a home. So it's like if our parents couldn't own a home to pass down to us, right, then we were at a disadvantage already before it was even our responsibility to try to get good credit. So researchers suggest that instead of using past behavior that might stretch back several years or more to predict future repayment behavior, credit scoring models should also look at cash flow and payment history on rent and utilities, such as the Ultra FICO and the Experian Boost that we mentioned earlier. A nonprofit data testing center analyzed cash flow underwriting, and the results showed that head-to-head it was more predictive than traditional FICO scoring. Currently, there is an enormous gap between Black and non-Hispanic white homeownership rates. Since credit scoring models look at homeowners' housing payments and ignores rental, Since credit scoring models look at homeowners' housing payments and ignore rental payment history, Black consumers are at another disadvantage, despite both types of payments falling under the same category of housing. Your credit score is determined by private, for-profit, publicly traded companies. Credit bureaus are under no legal requirements to be accurate, and today's credit reporting bureaus make a tremendous amount of mistakes at the consumer's expense. And this is very important to discuss as well, because a lot of people will have mistakes on their credit report, but don't know how to address it. So they end up just letting it sit there or paying on it small payments and not really acknowledging or contacting the people to let them know, hey, this isn't right. But I learned that early, because I can recall like an apartment complex or something like that, which was really crazy to me, because it's like you don't report as an apartment when I pay my bills on time, but if I move out and don't pay whatever fee that you said there is supposed to be to pay for things to be replaced, then that goes on my credit report. And so it was something like that happened, and I was like, wait, them carpets needed to be replaced before I got there. So that's not my responsibility to pay that. And it was like $700 on my credit report saying that this is what I owe. And I remember, because at the time I was substitute teaching, and I spent a large part of that day calling people and getting things around and being like, no, y'all need to fix this, because they told me that stuff was supposed to be repaired before I moved in. They didn't repair it before I moved in. They still let me move in anyway. And then they're trying to put the bill on me to replace the carpets? No. So I had that removed from my credit ASAP. But if somebody wouldn't know who to contact and how to do that, then they would just have that sitting on their credit report, making their credit score go down, or they would be paying on a debt that they really don't owe. So it's a very tricky system all in itself. A 2013 Federal Trade Commission study of the U.S. credit reporting industry discovered that 5% of consumers had errors on one of their 3 major credit reports. In 2020, the U.S. House of Representatives passed the Protecting Your Credit Score Act, which would amend the Federal Fair Credit Reporting Act. The bill's primary goals are to improve credit reporting practices by requiring stringent guidelines around data accuracy and giving consumers broader access to their information and more say in correcting false information on their credit reports. The bill never passed the Senate, dying in the last administration. So credit reporting agencies have almost limitless access to your consumer information. So they can know everything about you and make mistakes on your report and
not be held accountable. Is the gist of this last part of that article. So yeah, it's really crazy how things are created to make things more fair, when they just can also reflect the unfairness that already exists. Credit scoring is a pseudoscience, and it perpetuates the consequences of slavery and segregation, is our next article. Although society has allegedly moved away from credit monitoring practice that can be seen as overtly racist, the algorithms and the data that feeds them have been corrupted by generations of systemic oppression and financial exclusion of people of color. So instead of removing race from the equation, credit scores have become a direct proxy of it. Yep. Even though it has been 60 years since federal law has barred denying credit based on race and location, America's homeownership gap remains virtually untouched. Again, just to mention how those banks were exposed for not lending to Black or brown people simply because of race. Having bad or non-existent credit not only affects your ability to get
home, auto, personal, or business loans, but it can also have an effect on one's mental well-being. In 2020, a consumer survey found that of those with poor credit, 79% said it has negatively affected their mental health, with 46% reporting feelings of shame and another 30% reporting anger associated with their credit scores. In 2022, black mortgage applicants were denied at a rate of 84% higher than white borrowers. And then when they were approved, they often pay higher rates and fees even when adjusted for creditworthiness. So, it's just crazy that there is facts on this, there are studies on this. People dedicate 10, 15, 20 years to do these studies to look at these rates and of how people are still being discriminated against, and then everybody's just kind of like, oh well, versus trying to correct that.
Yeah. So this next article, why credit scores are racist, I'm just going to point out a couple of facts or percentages to you guys. As a result of history and many other factors, black home ownership rate is 44% compared to 74% in non-Latinx white people. Employment discrimination also is a factor. About half of black Americans live paycheck to paycheck, which also make it harder for them to be able to, effectively buy things and pay them off because they're living paycheck to paycheck. Since the majority of the credit score calculations are based on payment history and credit use, unstable income can quickly tank a credit score. Auto loans impact black folks' credit scores as well because many dealers charge them more for cars and place higher interest rates on their accounts due to their race. Personal credit scores are taken into account for business loans. Having a low score is a major barrier to securing a capital needed to start a venture or grow an existing one. The ideal loan for a small business is a government-backed loan called SBA-7A. It has a long repayment period and low interest rates. But to qualify for this loan, applicants usually need a credit score of at least 680. The same goes for private bank loans with favorable terms. Loans for people with lower credit scores come with much higher interest rates and add hundreds of thousands of dollars in payments over a lifetime of the loan. There is an alternative for credit scores that people have been looking into. It replaces shortcuts with the relationship. It's called a character-based lending, so CBL. CBL doesn't use credit checks or collateral, another financial practice with racist implications. Instead, it relies on community knowledge to determine creditworthiness. This year, Common Future introduced a pilot program for CBL, distributing almost $800,000 in low-interest flexible loans to applicants referred by the Common Future Network partners.
Yes.
Or
yes.
1/3 of what they give you on the card.
In
right?
general, like both really, because income, credit utilization, all of these things I looked at when.
I said all of them are tied into.
Yep, all of them are tied into each other, and all of them are factors when you're looking at buying a car, buying a house, and all of these things. Because nowadays, what apartments want you to have like 4 times or something like that?
Yep.
4 times. You want to make 4 times the rent. When I'm like,
Well, the prices don't even add up.
it's the math's just not mathing. So make sure you guys look up on your credit cards what's your interest rate. If you can be eligible for lower interest rates or ways to buy down your credit, ask for payouts, because some companies will take a payout if you owe $900, but you can't really pay that. Sometimes they'll make a deal because their credit is about to be dropped off anyway, so they're just trying to get whatever they can get. They might drop it down to $500, $400, something of that nature. So learn to inquire about these things and really check up on your credit and your credit report and seeing what is being reported on your things.
And before you try to go get any credit card or car, make sure you know what bureau they pull from.
Right.
That
It's
one
important.
too. That one too. It's free apps that you can have on your phone that will look at your FICO score, will look at your Vantage score, and just show you updates every time that it's reported. So make sure.
You're supposed to have a free credit report every year.
Every year you're supposed to have a free credit report, and it's very detailed. It tells you how much of your credit you're using, if you've had any hard inquiries on your report, which a lot of people find fraud that way. Like, I didn't apply for a credit card, and you gotta do some digging to be like, hey, that's not me. So make sure you're very aware and abreast, and you go to ain't nobody paying us. And you just go to these different avenues to find out this information.
FICO.com is where you can go receive your FICO score.
FICO.com. All right, you guys. Hope you learned something today. Hope you go forth and grab your credit report if you haven't already, just so you can look over and make sure that everything is on the up and up. That's it for this episode. Bye.
So this is a wrap for this episode. I hope y'all enjoyed it. You can follow us on Instagram, which is Hood Health Report, as well as Facebook and Twitter, Hood Health Pod.
We also have a TikTok page now, Hood Health Report. Follow us there.
Yeah.
Don't forget to subscribe to the YouTube channel. All of the links will be in the descriptions and the bios for you to click on easily.
Tap, like, comment, do it all.
Subscribe, all of the things. Share it with a friend.
Yes.
Share it on your social media.
If you have a TikTok, make a little video, send it.
Let us know you're out there watching, guys.